The oil shock started to reverse this week, and that changed the pressure on the whole tape. Welcome back to this week's market recap. The key driver was not that risk disappeared, it was that traders started reducing the war premium in crude. When oil backs off, inflation fear eases a little, yields get room to breathe, and equity multiples stop fighting the same headwind. That helped the record high story hold together even with inflation still above the Fed's comfort zone. The risk is that relief can fade if crude firms again or if volatility wakes up while price stalls. Buyers still need to prove this is real continuation, not just a low volatility drift. That is why the chart red matters now, because the closes look constructive, but confirmation still matters. The Dow Jones Industrial Average finished above 51,000 after a solid gain, and that tells us participation had more depth than just the usual growth names. For a weekly tape, that is a healthier breadth signal than a narrow index squeeze alone. The S&P 500 added a small gain and held near record territory, so this is the broad market decision layer. Buyers do not need fireworks here, but they do need the index to keep accepting higher prices instead of rejecting the breakout. The Nasdaq Composite also pushed higher, and that keeps the leadership red pointed toward growth and AI-linked risk appetite. The move is not huge on the surface, but it matters because leadership did not break while the market was testing macro relief. VIX closed lower near the mid-teens, and that is the stress qualifier. Low volatility supports the bulls, but only while price keeps confirming instead of flattening out at the highs. Bitcoin was basically flat near 73,000, so speculative risk is steady, not screaming higher. That keeps it as a supporting signal rather than the main driver of this week's equity move. Here is the decision block for me. If crude stays contained and volatility stays pinned, the base case is continuation with pullbacks getting bought. If oil snaps back higher, or VIX lifts while the indexes stall, then this turns into digestion first, and the market has to reset before the next push. So before we trust the breakout, we start with the pressure gauge. The next chart is VIX, because volatility calm is setting the stage, but the real question is whether that calm is supportive or stretched. The first read is supportive for equities, but it is also a complacency check. Last week, stress was not building, now the volatility calm has deepened, while stocks are pressing record territory. Today's close is 15.32, near the bottom slice of the past year, so the market is not pricing immediate stress here. Calm volatility zone is the key phrase, because this is not one quiet candle. VIX has been sitting there for several sessions, and that usually gives breakouts more room to work. 50 days average is up near 19.95, and VIX is still below it, so intermediate stress remains suppressed. 200-day average is near 18.38, and staying under that longer-term line keeps the volatility regime friendly for bulls. ATR of the VIX is only around 1.01, sitting in the lowest few percent of the past year. That is extreme compression, and extreme quiet is helpful until traders start leaning too hard into it. Base case is still that low volatility supports the equity breakout, especially with oil risk easing and yields getting less pressure from the energy channel. But I do not want to stop at the macro view. Shorter-term chart is where we check whether the calm is just staying calm, or whether it is getting stretched enough for a volatility bounce. Lower Bollinger Band is being pressed near 15.55, with the middle band closer to 17.25. That is not bearish by itself, but it says the calm is stretched. Switch the lower panel from ATR to RSI, because the RSI red is what tells us whether a small volatility bounce is getting easier. RSI red is the timing check now. If momentum starts turning up from this compressed zone, the market may need a pause even if the bigger trend is still intact. Base case stays simple. If SPY holds its breakout while VIX remains pinned, the low volatility backdrop still favors the bulls. Warning comes if VIX starts lifting while price stalls near the highs. That is when comfort can turn into digestion quickly. That calm zone is the line between supportive quiet and early stress. So now we move to SPY and ask the real question, is the S&P 500 confirming the breakout, or is it already stretched enough to need a retest first? VIX gave bulls a calm backdrop, and SPY is using that calm to hold a strong trend. The issue is not whether the market is broken. It is whether this record high push is getting extended enough to need a reset before the next clean leg. Golden Cross is still the regime here, with the bullish moving average structure in place for months, so sellers need more than one soft candle to flip the bigger read. SMA 50 remains above the long-term average and is still rising, which keeps the intermediate trend constructive. SMA 200 is well below current trade, and that confirms strength, but it also shows the market is stretched away from the slower trend line. Current price is sitting far above that long-term base, so I do not want to chase blindly. If buyers keep closing strong, the breakout can extend. If they lose momentum up here, a cooling phase would be normal rather than automatically bearish. Now the actionable part is the breakout line. Last time the problem was overhead resistance. That structure has now progressed because SPY is closing above that long-running cap for the first time. Price is above the key moving averages and pressing the breakout area, so the bullish side still has the edge as long as this does not immediately fail back under the line. Resistance line is the decision point. If price can stay above it, the move looks more like continuation than rejection, and the record high structure keeps working. RSI is stretched above 70, so momentum is strong, but it is already hot. That is why a retest or cooling phase would not surprise me. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling instead of accelerating. That keeps the pullback risk real, but not dominant yet. Volume overlay matters here because participation is not explosive. The latest volume is above its 20 days average, but the shorter 5-day read is quieter, so buyers still need closing confirmation. If price holds the breakout area, I treat dips as corrective first. If price falls back under it and cannot reclaim quickly, then the record high breakout starts looking like a failed break, and the next chapter has to ask whether QQQ leadership can still carry the tape. QQQ is the leadership check after the SPY breakout, and the message is clear: growth is still in control, but it is not cheap momentum anymore. AI-linked strength and oil relief helped the tape, but this chart still needs confirmation rather than a blind chase. Golden Cross remains the regime, with the bullish moving average structure in place for a long stretch, so sellers still have to prove they can do real damage. SMA 50 is still rising, and that keeps the intermediate trend pointed higher while buyers hold the trend. SMA 200 is far below the last candle, and that confirms strength, but it also says QQQ is extended from its long-term base. Current price is stretched well above that slower trend line. If buyers keep closing firm, leadership can keep pulling the market higher. If they lose momentum up here, a cooling phase would be normal before the next cleaner attempt. Now the actionable read is at the upper end of the structure. SPY has the broad breakout, but QQQ has to prove leadership can keep confirming instead of turning into the stretched part of the tape. Price is near the upper side of the current support and resistance structure, so the bullish side still has the edge while this area holds. Resistance line is the decision point. A hold above this area keeps continuation alive, but a fast failure back under it would start looking like a failed break. RSI is stretched above 70, so momentum is strong but already hot. That supports the trend and raises the odds of a pullback if buyers stop pressing. MACD has flipped back toward positive momentum, so this bounce has better confirmation than price alone. Volume overlay is the participation check. Latest volume is around its 20 days average, but the 5-day read is a little quieter, so I still want closing confirmation before calling this a clean chase. Support line becomes the first place to judge whether any pullback is healthy or turning into distribution. If QQQ holds the upper structure, it reinforces the SPY breakout. If it slips, the next chapter on IWM becomes important because we need to know whether breadth can carry the tape beyond mega cap growth. IWM is the breadth test after QQQ, and this is where the rally has to prove it is not only a mega cap growth story. The trend is still constructive, but small caps are also stretched, so this helps the bull case only if buyers keep defending the move. Golden Cross is still active, with the bullish moving average regime holding for months, so I am not treating small caps as broken yet. SMA 50 is still rising, and that keeps the intermediate trend supportive while price holds above it. SMA 200 is well below current trade, which confirms strength but also shows how extended this move has become. Current price is stretched above that long-term base. If IWM keeps closing firm, breadth supports the SPY breakout. If it stalls here, the market is leaning too much on large cap leadership again. The tactical read is less clean than the trend read. IWM is near the upper end of its structure, but the shape now looks more like a conservative rising wedge than a clean runaway breakout. Price is still elevated near the top of the structure, so buyers have control for now, but they need to keep accepting higher prices. Resistance line is the wedge cap. A clean hold above that area would weaken the bearish wedge read quickly and argue that breadth is broadening for real. RSI is still above 50, but it is cooling. That says momentum is constructive, not accelerating, and that matters when small caps are supposed to confirm the rally. MACD has flipped back toward positive momentum, so the bounce has better confirmation than price alone. That keeps the bull case alive, but it does not remove the wedge risk. Volume overlay is the participation check. Latest volume is around its 20 days average, while the 5-day read is quieter, so I still want proof through the close before calling this broad confirmation. Support line is the real risk trigger. If the lower wedge boundary gives way, the first cleaner downside reference is around 279, and below that, the small cap red starts pushing against the broader breakout. So IWM is not killing a rally, but it is adding a warning. If breadth holds, SPY gets support beyond AI leadership. If breadth fails, the next pressure point is yields, because small caps are very sensitive to financing costs and rate pressure. TNX is the pressure check after IWM, because small caps and growth both need yields to stay contained. The market got relief from lower oil risk this week, but the yield trend is not broken yet, so valuation pressure can still come back quickly. Golden Cross is still active, and that keeps the broader yield regime constructive rather than clearly bearish. SMA 50 is above the longer-term average and still rising, so the intermediate yield trend has not rolled over yet. SMA 200 is below current yield and price is still about 6% above it, so the long-term pressure backdrop remains intact. Current price is elevated enough that equities do not get a clean free pass. If yields keep bouncing, that weighs on multiples. If yields lose support, it gives SPY, QQQ, and IWM more room to treat pullbacks as corrective. The actionable level is the support test. Oil relief helped take some inflation premium out of the bond market, but TNX is testing support rather than breaking it cleanly. Price is still above the key moving averages, so this is not a confirmed yield breakdown yet. Support line has been active for roughly 62 sessions and yield is still leaning on it. For now, I still lean toward support holding until the close proves otherwise. RSI is near the 50 line, so momentum is balanced. That means the next price reaction matters more than the indicator by itself. MACD momentum is fading below zero, so the chart still needs confirmation before this becomes a clean bullish bounce in yields. SMA 50 is nearby as the first moving average pressure point. If yield can hold around this area, the cleaner path is a bounce back toward the middle or upper side of the structure. 200 days moving average is still lower, so a deeper break would matter because it would start taking real pressure off the equity tape. If TNX closes below this support area, the bounce story gets damaged fast and equity pullbacks look easier to buy. If support holds and yields turn back up, the next chapter on oil matters even more, because crude is the inflation channel that can put rate pressure right back into the tape. Crude is the inflation pressure valve after the yield chapter, and right now the chart is helping the equity tape more than hurting it. The de-escalation signal pulled war premium out of oil, but the long-term structure has not fully broken yet. Golden Cross is still active, so I am treating this as a correction inside an intact broader trend, not a confirmed long-term reversal. SMA 50 is still above the long-term average, but price has slipped below it, and that is the short-term damage. SMA 200 is still rising underneath, so the bigger oil trend has not fully rolled over while crude stays above that slower line. Current price is below the shorter trend line, and that keeps the near-term read heavy. If crude stays under the 50 days area, inflation pressure keeps easing. If it reclaims that area fast, the oil relief story gets weaker. The actionable read is still rejection first. Oil is trading in the lower half of the structure, and that matters because lower crude can help yields stay contained while equities test their breakout. Price is around the high 80s, below the 50 days area, so buyers have not repaired the damage yet. 50 days moving average is the first reclaim level. Until crude gets back above that line, the short-term read stays soft. SMA 200 is lower and still rising, so that is the broader trend floor if sellers keep pressing. Resistance line is still the upside cap, and a clear reclaim would flip the read away from rejection and back toward a recovery attempt. RSI is below 50 and fading, so momentum has not repaired. That keeps sellers in control unless price starts reclaiming levels quickly. MACD momentum is fading below zero, and that confirms the pressure is still pointed lower rather than stabilized. Support line is the downside reference if the slide continues. If sellers press crude lower, that takes inflation pressure off the bond market. If oil snaps back above the reclaim area, the next chapter on Nvidia has to deal with a tougher macro backdrop again. Nvidia is the final leadership check after oil because lower crude helps the macro tape, but the AI trade still has to hold its own structure. The long-term trend is not broken, but this is no longer a clean chase setup after the pullback. Golden Cross remains the regime, with the bullish moving average structure in place for months, so I am not treating Nvidia as a broken leader yet. SMA 50 is still rising, and that keeps the intermediate trend supportive while price stays above it. SMA 200 is well below current trade, which confirms the broader trend but also shows the stock is still extended from its long-term base. Current price is still above the moving average structure, but the distance from the 200-day line means buyers need confirmation. If NVDA stabilizes here, it supports the broader breakout. If it keeps fading, AI leadership stops helping the tape and starts reinforcing the cooling phase. The actionable read is support first. NVDA is testing the rising support line, and this is where the AI trade has to show whether the pullback is controlled or turning into something heavier. Price is still above both key moving averages, so the structure is damaged, not broken. Support line has been active for roughly 43 sessions, and price is testing it rather than breaking cleanly. For now, I still lean towards support holding until the close proves otherwise. SMA 50 is the nearby cushion. If that line holds with price, the cleaner path is a bounce back toward the middle or upper side of the structure. 200 days moving average is still lower, so the bigger AI trend remains intact unless sellers start doing real damage below the near-term support area. RSI has slipped below 50, so momentum is shifting towards sellers. That is the warning inside an otherwise intact trend. MACD momentum is fading below zero, so the chart still needs price confirmation before this becomes a clean bullish bounce. Volume overlay matters here because participation is elevated. Latest volume is above its 20 days average, so the support test has real attention behind it, not just quiet drift. If support holds, Nvidia can still anchor the AI trade and help the broader market treat any pullback as corrective. If it closes below this area, the bounce story gets damaged quickly, and the market heads into the conclusion with leadership no longer giving bulls a clean pass. The market finished strong, but I still do not think this is a clean chase signal. Last week, the warning was that price needed confirmation through the close, and now that warning matters even more. Overhead decision zone near 758 is the line I care about first, because price has broken into record territory but is still testing the upper trendline area. Again, price can keep pushing higher, but I would not blindly chase it into that resistance cluster without confirmation. RSI at 74.1 says momentum is still strong, but it is already hot enough that a sloppy push can turn into rejection quickly. Upper Bollinger area is being tested too, and that tells me the tape is strong but stretched. Again, no indicator is perfect, but strong RSI, hot stochastics, and price pressing the upper band all say the same thing. Buyers have control, but the setup is not cheap. Open gap below around 725 to 727.8 is still unfinished business under price, so this is not just a clean upside story yet. The macro driver helped the bulls this week. Oil relief lowered some inflation pressure, yields eased from stress levels, and that gave the breakout more room to breathe. Again, the macro story does not replace the level. It only changes the probability around the resistance zone and the first pullback area. Overhead decision zone near 758 still decides whether buyers are actually accepting the breakout or only spiking into it. That is why I care more about the close than the intraday high. A brief trade above the level is not enough if sellers take it back before the bell. From here, I am shifting this into the thesis map for next week. The current chart is strong, but the next move still needs proof through the close. Path I am tracking first is controlled continuation, but only if buyers hold the breakout structure around 758 instead of giving it back. Resistance cluster around 758 is the first test again. If buyers push into that area and do not get sold right away, the breakout keeps the edge. Primary support cluster around 739.3 is the first place I would want buyers to step in if the market cools off first. If that fails, the cleaner risk path is a pullback into that 739.3 support zone before buyers get another real chance to stabilize. Support cluster around 739.3 is not automatically bearish. If buyers defend it cleanly, the reset can stay corrective instead of turning into a trend failure. Open gap below around 725 to 727.8 becomes the next magnet if sellers keep pressure on and buyers cannot respond at the first support shelf. Again, that gap is the uncomfortable part of the bullish story. The market can go higher, but it still has unfinished business underneath. Realistic year-end objective sits around 790 to 795. If the breakout holds, the trend stays firm, and the market keeps accepting higher prices. Path I am tracking first has statistical support too. After fresh all-time highs, the S&P 500 was higher 20 trading days later in about 66% of the last 5 years of cases. If that fails, history also says a quick red day is normal. A down day inside the next 2 sessions happened in roughly 59% of those cases, so a pullback would not shock me. Again, the line in the sand is simple. Buyers need to hold the breakout structure near 758 or quickly defend the 739.3 support area if the market cools first. Do we get the gap and go, or do we fill the gap first? That is the whole trade map into next week. That is the full weekly read. Watch the 758 breakout area, respect the 739 support zone, and let the close confirm the next move before chasing it. Thanks for watching, stay sharp, and I will see you in the next market recap.